joining tonight's class. I'm joined by my fellow colleagues, Kolisa, who is e-tutor for Group 12, and Kucho, who is e-tutor for Group 11, and Zolisa, who is e-tutor for Group 36. Okay, so without wasting any further time, I will get into the purpose of tonight's class. So in tonight's class, we are going to discuss study unit 7, where we will discuss the two inventory systems and cover the differences between them, including the journal entries. Then I'll also discuss the valuation of inventory, which is in study unit 10. And then after that, Kolisa will take you through the exercise 7.9.2 with you guys. Okay. So, just by show of hands, before I continue, can everybody hear me? Perfect. Okay, so what is inventory? So we have, there are two main types of businesses that hold inventory. You have the manufacturing business and you have the merchandising business. So in the manufacturing business, they buy raw material, which they make into finished goods, which they then sell to earn profit. Whereas the merchandising business, they do things a bit slightly different. They buy goods that are already produced and then they sell it to earn profit as well. So with that in mind, what is inventory? Okay, so the simple definition is inventory or trading stock are items that are purchased for the purpose of reselling them at a profit. And they can be classified as all or any of the following. So it can be goods that are kept to be sold in a normal course of business, which we've just seen now is the merchandising business, or it can be goods that are in the process of being manufactured for sale, which would be in the manufacturing business, or goods that are used during the manufacture of inventory. And lastly, it can be consumables. By consumables, it is items that you use in a day-to-day operation of the business. For example, stationery. And inventory is classified as a current asset. Why? Because businesses intend to sell, use, or consume that inventory within 12 months. So that's why we classify it as a current asset. Does that make sense to you guys, or do we have any questions before I move on? Can one of the tutors just tell me if there's a question?
A thumbs up, not a question.
Okay. Okay, if there's no questions, then I will move on to the next one. Okay, so let's imagine that you own a merchandising business, right? So load shedding is back and winter is fast approaching. So you decide to open a business. Let's call it Load Shedding Dismiss Pty Limited, where you sell batteries that can last up to 48 hours. So you buy your batteries from a Chinese manufacturer. Let's say for now you buy it, we will only look at one battery for now. Let's say you bought it from the Chinese manufacturer for 10,000 each and you bought it in cash. Then you intend to sell this battery to your customers, which that battery now becomes your inventory, which you now intend to sell to your customers for 15,000 each. So how are you going to account this in your books? Right. So for each battery that you sell, there are two transactions, okay? So there's one transaction that takes place when you buy the battery, and the second transaction will take place when you sell the battery. So for transaction one, you bought the battery, which is now your inventory for 10,000 in cash from the Chinese manufacturer. So you debit inventory. And why do you debit inventory? Because you should know by now that inventory is an asset. So you debit it to increase your asset because you now have the stock in your business. And you also paid cash for this battery from your manufacturer. And bank is also an asset. So money left your account. So you also gonna credit bank to show that money left your account. So that will be the transaction that you record for the purchase of your inventory. Now for transaction 2, when you make the sale. So for the sale of the battery, there are 2 journals that you need to record. One is for to recognize the revenue, and the second one is to recognize the cost of goods sold. So you sold, so the customer, let's assume now the customer bought the battery from you on credit. So hence you debit the trade receivable account to show that you are owed money. And trade receivable is also an asset. So you debit it to show that I am owed money. And you increase your trade receivables. And then also you made a sale. So that is the income for you. And you know that income, it increases on the credit side. So then you credit the sales account with 15,000, which is the selling price. So what happened now is that the battery that you bought from the manufacturer, you sold it now to your customer. So you have to release the cost of goods sold to the incomes from the balance sheet to the income statement. So you then debit the cost of goods sold, which is an expense account, with the cost price of your battery, and then you credit the inventory account. So now you no longer have that battery, you have sold it, so you credit the inventory account to decrease it with the same cost price of your inventory. So at the end of the day, in your income statement, you'll be able to calculate how much profit you made, because you'll have your sales, which is 15,000, then you'll have your cost of goods sold, which is an expense, 10,000, and the difference between that will give you your profit or your cost or your gross profit. Okay. Right, so for now, we only looked at one transaction, right? So what happens when your business grows? How will you record or track thousands of transactions at the same time? So the answer lies in the inventory system. Okay, so businesses can use either the perpetual inventory system or the periodic inventory system to record and track to record or track their inventory. So this will depend on the nature of the entity and also the type of merchandise that they sell and the level of computerization that is available in the entity. Okay, so now let's discuss the 2 inventory systems and the differences between them. And before that, I just want to see if we have any questions.
Yes, we do. We have one question that's asking, how did we calculate the 15,000 on trade receivables? And can you please explain 2.1?
Okay, it's not necessarily a calculation. Let me go back. So 2.1.
Sorry to interject. Students are requesting that we go a bit slower. They seem a bit fast.
Okay, I'll go a bit slower. So the 15,000, there's not really a calculation behind it. It's just the selling. So you bought the battery for 10,000. So you obviously want to make a profit from that inventory that you sold. So that's why I said, let's assume you intend to sell the battery to your customers at 15,000. There's no formula behind that. Does that answer the question, Kucho?
Have thumbs up, so they are okay. And then they're still asking on why are we saying stationery is an asset instead of an expense. We had a respond on the chat that explained it, that is explaining that it depends on the reason why we bought the stationery. If we bought the stationery for use, which is part of operations, it would be expensed. And then if we bought it as part of stock, then stationery will be kept as stock.
Okay. And then is that it? I see a few hands that are up.
That's thumbs up. I think maybe we can explain that for hands up, we are not going to respond. Maybe they should type their questions because they are disabled. That should help. Maybe please text your questions and then let us know if you are not clear yet. Because when you see thumbs up, we're assuming that we've answered the question. But then if it's still not clear, just raise your hand. They're asking for a 2.2 as well.
What about 2.2?
To repeat, to explain the whole process.
Okay, let me just explain the whole transaction then. So let me go back. Right. So I said let's assume that you own a merchandising business, okay? So you see that load shedding is back and winter is fast approaching, so you decide to open a business. So it's just an example. So you call it load shedding dismissed. So you find a supplier in China that you can buy batteries from. So you buy those batteries at 10,000 cash. I said you bought it for cash at 10,000. And for now, we only looked at one battery that you bought. And then you intend to sell that inventory to your customer because the reason you started the business in the first place is to make profit. So you decide to sell the inventory or the battery that you just bought from your supplier at 15,000 each. Right? And then one of your customer will buy it from you on credit. And by credit, I mean that you did not get the cash immediately. The customer still owes you money. They'll pay you on a later stage. So then my question was, how are you going to record this transaction? Okay. So with each battery or with this battery that you sold, there are two transactions. One happens when you bought the battery from your supplier. The second one is when you sell it. So for the purchase one, how are you going to record it? So you bought the battery, okay, which is your inventory. Inventory is an asset. So you debit the asset account by 10,000, which increases your asset. And you bought this battery in cash from your supplier. So hence we credit the bank account to show that money left our account, therefore decreasing our bank balance. Then the second transaction, here you will have two journals, right? One is to recognize the revenue or the sale. The second one is to release the cost of inventory from the balance sheet to the income statement, because you no longer have that inventory in your store because you sold it already to the customer. So 2.1, when you recognize the revenue, so if the customer bought it cash, you would have debited the bank account to show that you received money. But in our example, they bought it on credit. So hence we debit the trade receivable account to show that we are owed money. And this is also an asset account. And then you credit sale. Sale is income. So remember one of our e-tutors, when she was teaching you how to debit and credit, she came up with a cheat code. I think it's debt click. So income falls under the click. So everything that falls under click, you whenever it increase, you credit it. So sale, you credit it to show that you received. It's an income account. So you credit it with 15,000, which is your selling price. And then the second one is when we release the cost of our inventory from the balance sheet to the income statement. So you debit the cost of goods sold with the cost price of your inventory, which is 10,000, and then credit inventory to decrease it because you no longer have it with 10,000. Does that make sense?
I'm getting thumbs up, so I think it's clear now.
Okay. And I'll move on. So then I said,
we have a hand up. Maybe let's allow the
back.
individual. Okay, let me allow her. Zolis. Oh no, it's Zolisa, so you can continue, I think.
Okay, can maybe ask them to put their hands down?
Yes, can we please have Sibani and Sipose to okay, we have T who just raised his hand up. Okay, that's a new hand. Okay, we don't have okay, the hand is it up? Okay, do we have it? I think we don't have hands. It's okay. Thanks.
Okay, then I'll continue, right? So then it brought us to the inventory system. So in our example, we just looked at one transaction. So then I ask, what will happen if your business grow, right? Instead of buying one battery, you're going to buy thousands of batteries. So how are you going to record or track those transactions? What system are you going to use? So that's when I said, okay, if my business, the answer lies in the inventory systems, which is the perpetual continuous inventory system or the periodic. So businesses can use either of this system to record and track inventory. And this depends on the nature of the entity and the type of merchandise that they sell and the level of computerization in the entity. Okay, so now let's discuss these two inventories and the differences between them. So with the perpetual inventory, which means continuous, every time when you buy inventory and when you sell it, you record them straight into your inventory account at the same time you do the transaction. Whereas with the periodic system, we don't do that. Cost of sales is calculated at the end of the period and not when the sale takes place. So you can just by glancing through the slide, like from point number 2, 3, 4. So in number 2, when you purchase inventory, we debit the inventory account just like we did in our example. Whereas in the periodic system, you debit the purchase account. And why do we do that? Because you don't keep continuous record of your inventory. So it wouldn't make sense to adjust the inventory account because what are you adjusting? How would you know if somebody buys an inventory, how would you know which item did they buy and at what price? So that's why with the periodic one, you do not record the purchase or the sale of the inventory in the inventory account, only in the purchase account, and you only calculate your cost of sales at the end of the period after you do a physical inventory count. So I'm not going to go through all the points here because we're going to discuss it in the next slide when we look at the journal entries and each of these inventory systems. Okay, so let's start. So this is just a summary of the journal entries that you would record for each transaction, depending on the inventory system that is used. So when we purchase inventory in the perpetual system, we record the inventory account, as we've seen in our example, which is regarded as an asset. Hence, you debit it. So depending on whether you bought the inventory in cash, if you bought it in cash, you credit the bank account to show that money left your account, your business. And if you bought it on credit, you'll then credit the trade payables to show that you owe money. Whereas in the periodic system, you debit the purchases account, which is an expense account. It's not an asset, it's an expense account, and expenses increases on the debit side. And also here, it depends if you bought it cash, then you credit bank. If you bought it on credit, then you will credit trade payables. And now when you sell that inventory to your customers, in the perpetual in the perpetual system, there we will have two journals, whereas in the periodic system you'll have one journal. So the perpetual, as we looked in our example, you'll debit cash if the customer bought the inventory in cash, or you'll debit trade receivable if they bought it in credit. And then you'll credit your sales account to show the income that you received. And the second one is when now you release the cost of inventory from your balance sheet to your income statement. So you debit the cost of sales account, which is an expense account, and you credit your inventory account to show that the inventory has left your books. So I put in number 2 a question mark. Does anyone know why when you sell inventory and you're using a periodic system, why you do not calculate cost of sales? Can you just type on the chat, and then Kucho or one of the tutors will let me know if what answers you guys give. Kucho, you'll let me know, right, when to proceed.
All right, we don't have a question as yet or a response. They're saying they're
I just
hearing
want the
us.
response. Why would you not adjust the why would you not record cost of sales if using periodic?
Okay, we've got answers now. One is saying that because we account for it at a later stage. No, they're moving so fast. And then the other one is says no cost of sales account are kept using periodic. And then the other one said because you only calculate at the end of the period.
Yeah, that's correct. So we only calculate at the end of the period. That's why. Okay. And then sometimes your customers will return the inventory that they bought from you. They'll return back, whether maybe they're unhappy with the sale or there's something faulty with the product that you sell. So in the perpetual inventory system, you'll also have two journals. Remember when you sold it, there were two journals. Now when they return it, you're gonna do the opposite. So you'll debit your sales return. You'll debit sales return at your selling price, and you credit bank. If the customer bought it on cash, then you have to return that money back. And if it was on credit, you credit trade receivable to show that you no longer owed that money. And then the second one is that now you need to put back the cost price of the inventory that was returned into the balance sheet. So you debit the inventory account. Remember, it's an asset. To put it back, that is increasing it, and then you credit your cost of sales and expense, which will then decrease. Whereas in the periodic is just one journal, which is you debit your sales return and credit bank or trade receivables, if depending on how the sale was done. Okay, next. So what happens when you return inventory that you bought from the supplier? What happens when you return it? So you will debit the bank account if you bought it on cash and the supplier agreed to refund you the cash. That means you receive the money back into your account. So you'll debit bank or you'll decrease your trade payables by debiting it if you bought it on credit to show that you owe less money to that supplier. And then you credit inventory because now you returned that inventory back to the supplier. You no longer have it, you decrease it. And assets decreases on the credit side. Whereas in the periodic, it does not touch the inventory account. It goes straight into the, you only adjust the purchase return account, and the only thing that will be the same as the perpetual one will be the debit side, where if you bought it cash, again, you will debit bank, and if it was on credit, you'll debit trade payables. Okay, before I continue, do we have any questions?
It was agreed that let's take questions at the end.
Okay, no problem. Okay, just like a lot of you said on the chat, we do not record cost of sales in the periodic because it's done at the end of the period. So there's a formula which I'll show you guys in the next slide where that will show you how to calculate cost of sales in a periodic system. So let's just go there and I'll come back to this. So the calculation of cost of sales after and this is done after you have done the physical inventory count. You'll take your opening inventory, which is any stock that was not bought in the previous year, plus purchases. The current year, maybe you bought more stock, so you add the purchases, which then will give you the goods available for sale or inventory available for sale. Then after you did your physical inventory count, you'll know what is left in your inventory. Then you minus your closing inventory at cost, and then you get your cost of sales. So let me go back to the previous slide.
Sorry to interject, Pam. They're still complaining about the pace.
Oh my word. Okay, I'll try to be slow again. Okay, so after you've done your physical inventory count at the end of the financial period, this is I just did a general ledger example here. So please don't get confused by the amounts. These are just examples. There's no formula and there's no calculation behind it. These are just numbers that I thought out of my head. So you'll create a general ledger, cost of sales, and then you will debit any purchases that you made during the year. You'll debit here. So this speaks back to the formula that I just showed you. So we'll debit our purchases with, let's say, 10,600, and then you'll debit also opening inventory if you had any in the previous year, which was here in our example is 10,000. Then if you had any inventory left at the end of the year, you'll then credit it so that you carry it forward to the next year. So at the end, 20,600 will be your cost of sales in a periodic system. Okay, so that's done. So additional purchase costs. So with every inventory that you buy, you will also incur other costs. By other costs, the most common one will be transport cost, or it like carriage on purchases, or it can be customs and excess duties if you imported the goods. And these additional costs are treated differently for each inventory system. So in the perpetual system, transport costs like carriage on purchase and other related costs are debited directly to the inventory account. Whereas in the periodic system, we don't adjust the inventory account. There is a special account for carriage on purchases. So then you will debit all the carriage cost into that account. So this one is just to show you how to treat additional costs that you incur when you purchase inventory in these systems. Okay, so here is just a summary of what we just discussed. So payment on delivery cost on inventory. As I've said, in a perpetual inventory system, you adjust the inventory account. So you'll debit whatever the cost that you incurred to deliver the goods or to insure your goods, you'll debit the inventory account with that cost. And if you paid cash, then you credit bank. And if you paid on credit, then you will credit trade payables. Whereas in a periodic inventory system, you will debit the special account, which is carriage on purchases. And if you bought it cash, then you credit bank. And if you bought it on credit, then you will credit trade payables or creditors. That's just another name for it. Okay. Then next, what happens when there's drawings or donations? So with drawings is when you as an owner take inventory out from your business, and donations is if you donate it to a charity. So how would you record that the transaction in this situation? So if there's drawings in the perpetual inventory system, you will debit drawings and you will credit the inventory account. So you adjust the inventory account. And then if there's a donation, just the same, but you then debit donations and then credit the inventory account. Whereas in the periodic inventory system, the debit side will be the same as the perpetual, but it's just that you don't adjust the inventory account. It goes straight to your purchases account. Okay, then moving on, let's discuss markups and what is meant by markups. So markups literally means the amount you mark up the cost by. So you increase the cost by. This means the amount you increase the cost by to get the selling price, and it's expressed as a percentage of cost. So in the exam, the lecturers can tell you that the markup is on cost price or the markup is on selling price. So markup on cost price is the difference between the cost price and the selling price, whereas markup on selling price, you can think about it as gross profit. How do I get to my gross profit? You say sales minus your cost of goods sold, which will give you your gross profit. So let's just look at an example. Let's go back to the example that we use on batteries. So let's say they'll give you that cash sales batteries. So you sold your batteries for 15,000, but you don't know what is the cost of that battery. You want to work out what is the cost of that battery, and then they'll tell you that the markup is on cost price at 50%. So how are you going to work out the cost price? So cost is in this part, cost is expressed as A, or is shown at 100%. So the formula will be selling price is equals to cost plus markup, which is your profit. So then you put 100%. So cost will always be expressed as 100%, and then 50%, which is given. They will always give you this amount. You'll never have to work it out. So you say 100% plus 50%, which gives you 150%. So that is your markup. So how are you going to work out the cost price of that battery? You say 15,000, which is the selling price, divided by your markup of 150%. Then you get to the 10,000, which is your cost price. I think I should ask a question here, Kucho. Does the student understand?
I see thumbs up, and then others are saying no. There are thumbs up, and then the others don't know. So, but then there are a lot of thumbs up.
A lot of thumbs ups. Okay, then
Yeah.
that's a good sign. Okay, so same. Now let's say they tell you that the markup is on selling price. Remember I told you, like, when the markup is on selling price, think about the gross profit margin, and think about how do I get to the gross profit margin. You say sales minus cost of sales, and that will give you the gross profit. But here, just think about it as a percentage. So I have the formula here, sales minus cost price will give me my profit. So here under this one, sales is expressed as 100%. But I want my cost price. I don't know how much is my cost price. The lecturers only gave you the selling price. So that's why I put an X here, because we have to work it out. And they gave you the percentage. So this one, the same as the markup on cost price, they'll always give you the percentage. You don't have to work it out. So the profit is 25%, which is your gross profit. So then high school maths, you'll say 100% minus 25% will give me X, and then 75% is X, which is telling me that 75% of 15,000, that is your cost price. Okay, does that make sense? Could you just get a feel in the chat?
Okay, we have some thumbs up. They're asking that when you speaking to sounds, may you kindly use the cursor. That's the request.
Oh, the cursor like this. Okay, but can I continue?
I see thumbs up.
Okay, moving on then. So this is just a small summary on markups. Glad you guys understand. So we are done now with study unit 7. So in study unit 7, we only focus on inventory. So that closes our topic on the inventory systems. So now we come to the inventory valuations. Okay. So back to what we just discussed. All the time we assume that the cost price of our inventory does not change. It remains the same. But it's not always the case. In reality, the cost price of your inventory will always change, whether it's due to inflation, whether it's due to economic factors. It will always change. So then you are faced with a dilemma to determine what is the correct value of your inventory at the end of the period. Why? Because your cost price will determine your selling price, and at the end will also affect the profit. So it's very important that you value your inventory correctly. Okay, let's keep this formula, following formula in mind so that I can just explain what I mean. So let's say last year your opening inventory, you bought it at 10,000 each, and then the current year, the supplier decides to increase the batteries by 6%. Now you're no longer paying 10,000 for the batteries, you're going to pay 10,600. So let's say now this is the periodic system. So you have, what is the value of your closing inventory at the end of the day? Okay, so that's what I mean by inventory valuations. So there are methods In accounting, there's always an answer for everything. So there are methods to value your inventory. We have one, the historical cost, which this one is applicable for FAC 1502. You have the FIFO, which is first in, first out to determine your valuation. And then there is the weighted average method to determine the value of your inventory. And lucky for you, you don't have to know how to apply number 2 and number 3. You just
Hi,
need to,
Pam. We
yes?
have a request. The students are saying that before we go to study unit 10, can we ask, maybe go through the questions for study unit 7, then so that they're with us when we go there. Is that okay?
No, starting with 7 and 10 are linked. So it will help also when you guys do the questions. And it's very short.
Okay, no problem.
Right. Okay, as I was saying, lucky for you guys, you don't have to know how number 2 and number 3 is applied. We're only going to test you on the historical cost. So what is the historical cost? Historical cost is the original purchase price of your inventory, which includes what? So these are all the costs that are directly associated with bringing the inventory to the location and condition suitable for sale. For example, you bought your battery from China, so you're going to have the purchase price. And if he gives you a discount, then it's going to be net of discounts. Then you're going to pay any transport costs that you incurred to get those batteries to South Africa, input duties, and railage is also just another word for transport costs as well as carriage and insurance. So in the historical, what we mean by historical cost is the original purchase price together with any additional cost that you incurred to bring that inventory to the location and condition suitable for sale. Okay, so that's basically study unit 10. It just looks at the inventory valuation. Hence I said it's short. So how are you going to disclose the inventory in the financial statements? Okay, so inventory is disclosed in the statement of profit or loss and other comprehensive income as cost of sales. So just as we had, if you remember our previous example, when you sell, you will credit the sales account or the income account, you credit it, and then you will debit the cost of sales account, which is just when you're releasing your inventory from the balance sheet to the income statement. So we had 15,000, I think, as a sale, and then the cost of the battery was 10,000. So your inventory here, the cost of inventory will be presented here in the statement of profit or loss. And then inventory is also disclosed in the statement of financial position as a current asset. So this is just an extract of the statement of financial position, which is balance sheet. So you'll have your asset, non-current asset, which will include property, plant and equipment and other items. Then under current asset, that's when you're going to also present the cost of inventory on hand at cost price. Okay, so that concludes my part. We can take questions now.
Just before the questions, I can see some people complaining in the comments, but I think it's more for them than for you, Pamela. So I think the class is recorded, the slides will be made available. So I think and people take different times to understand concepts, which is fine. I think we're all different. So I think if you don't understand, or if you feel at some point Pamela went fast, I think there's quite a lot of context to go through. So she couldn't go slow or be here till 11. So I think it is fortunate that 1, the class is recorded. 2, the slides will be made available with the recording. So I think if at any point you probably got lost, my advice is please go back, take the time, listen to each slide, pause, do your own notes. I think that might help a lot. I understand that, yes, we're not all the same, which is natural, but I think if you feel that you at some point got lost, I think that will help a lot.
I think it's important, guys, you need to make use of your eTutor's websites, as well as whatever other social media is available, and also make use of your lecturers when you don't understand something.
Yeah. Okay, can we
Must
move
I
on?
start the exercise?
Yes, I'll stop presenting.
Okay, I'll present now. Can everybody see? Can everybody see the exercise in front of me? eTutors, can you see this? Can you see?
Yes,
we
we can
can.
see.
Okay, cool. All right.
Oh,
So,
Lisa,
sure.
I think there are questions where people are asking if they can ask questions about the slides before getting to the question.
Yeah, I'm
Oh,
sure they
okay.
can.
Yes. That's perfectly fine. Sorry. That's perfectly fine.
Yeah.
Yeah.
I'll present again.
Okay, we will start
Let me
with
see. Where is it?
Sibani. Maybe let's try to unmute her. Allow Mike. Sibani can come in. Okay, Sibani is not coming in. So we will just mute. And then we have Tulisile. Let's check if she is available. Let's allow her mic. Tulisile.
Hi everyone. Hi Legends.
Hello.
Mina, I got lost on the markup, guys. Mhlambe, if you can just a little explanation for the markup. Like I'm really lost on the markup. Mhlambe, a little explanation I would be better.
Okay, I'll try and use an example. Just give me a sec. And open was a good example in one of the study guides. Then we can do it together. It's quite short, so I won't waste too much time.
Pamela, while you're still looking for it, just on the markup, so is the question on the calculation or on the concept? Because I can see people asking about general knowledge, because I think, okay, I'll let you, since you found it, go into it.
Yeah, she can answer so that we know if we answering her question correctly.
Mhlambe,
Can
if
you even see my screen?
yes,
we
I can see
see
your screen.
Okay, so this was an exercise in the study guide 7 in page, what page is this? Page 7. So I'm not going to go through. So just read here. It says the following exercise illustrates a perpetual inventory system. So they give you the opening balance and transactions that took place during 20.1. So at the bottom here, you see they say credit sales. So you made credit sales or customers bought from you on credit for 75,000. Right? Then you made cash sales and for 25,000. So here the markup is on cost price. The markup on cost price is 25%. So you don't know, they didn't give you what is the cost price of those inventory that you sold. So you need to work it out. Okay, so I'll stop presenting and go straight to Excel so that we can do it together. You can see my screen. I'll make it a bit bigger. Okay, so we had number one, you had credit sales of 75,000. Then they said markup is 25% on cost price. Right? And then you had two cash sales of 25,000, and the same markup is 25% on cost price. So they gave you the sales, but they didn't give you the cost of sales. How you want to work out? So we said that our selling price, to get to our selling price, right? It's equal to, if you say selling price is equal to your cost price plus your markup or profit. Okay. So what is yours? So in this, if the markup is on cost price is is shown at 100%. Okay. And the markup they gave you, it is 25%. Right? So 100% plus 25% gives you 125%. So then what is my cost price? That divided by that, 60,000. Okay, so the second one will work the same way. I'm not going to go through it just for the sake of time. Okay, I think we continue, guys, with the exercise.
Yes, we can. We'll take I think let's take questions. We now have Luande, and then I'll just we'll go through. I'll just unmute you guys, allow you guys, and then come in. You come in.
Hello, ma'am. Am I audible?
Yes, you are.
Okay. I wanted to ask a question based on the periodic system, the formula. I think back at high school, we used to have custom duties, import duties, and carriage on purchases on the formula. They were included on the formula. And when Ms. Pamela here showed the slide of the formula, I didn't see these three parts, of which I'm not sure if they are included here or what. Are they far?
They are included. Maybe I just neglected to include them in that slide, but you do include it in the formula. So it will be part of, I just want to present again.
Okay. So another question is on the markup. I think it was markup on selling price. The slide that it showed based on the markup. Can you please explain it a little bit more? Thank
Okay,
you.
first let's deal with your first question. So here, so this is what the first question related to this one.
Yes, ma'am.
So I just neglected to include it, but it will be actually, it will be under here. So your purchases for the year, it will include all the costs that you incurred in that year to buy your inventory, which obviously will include your transport cost, insurance, customs, etc.
Oh, okay, I get it now. All right.
Okay, and then the next one, we wanted to know Markup on selling price.
On selling prices.
Okay, I think there was also an example in the study guide. I have to find it. Okay, so this one is in page 8, but it wasn't included in the original question. They just said here, suppose that the markup of 25% is on the cost, not this one. Yeah, just below here. So if the markup of 25% is on selling price, how would that be treated? So let's go back to Excel. Is it there? Okay, so let's assume that 25% is markup on selling price. So remember in this,
Sorry.
yes?
Can you use maybe 30% instead of 25%, if you don't mind?
30%. 30%. Okay. So remember when I presented this slide, I said, think about the gross profit margin, how you get there. You have sales less your cost of sales, which will give you your gross profit. Yeah, they said that it is say in this part, what I said is that sales will be shown at 100%. What I'm missing is my cost of sales. I don't know what it is, but they gave me 30%. So what is my cost of sales? Basically the difference between these two. 70%. So which means if we take 75%, my cost of sales is 70% of the selling price.
Okay, so what you mean when you say sales here are going to be 100%?
So you show
if
it,
we are
you assume
given,
it's 100. Sorry for
if we are
cutting
told that
you.
okay, if we are told that 30% of markup on selling price, we are going to assume that sales are 100%.
So sales will be shown as 100%.
Okay. All right. Thank you, ma'am.
Yeah, stop presenting. Any questions?
Can move to the next one, which will be Zamani. And then Lesedi. I think just go on like through the numbers when one is done so that we move.
Good evening, everyone. I just wanted to ask quickly if it's not going to be addressed, just in case. On the return of inventory that we had bought on cash, say we charged or there is a handling fee that we might be charged or occur. How do we then treat it on our statement?
So by handling fee, what do you mean handling fee?
You sometimes when you buy something and then you return it, the supplier might charge you a handling fee, administrative fee, handling fee. Maybe it could be a 10% or a 5%, depending on their terms and conditions. But there is there will be a fee that might be withheld and not refund us the full cost price that we had bought the inventory on. Is there a way, or is there where we can treat that portion, or we just take it as a loss?
Okay, Ichuches will help me here, but let me present if I understand your question correctly. I'll go back to Excel. So you're saying, okay, you had inventory, let's use 500 Rand. You bought it for 500 Rand.
Yeah.
Okay, and then you return it,
Mhm.
which is you return the full 5,000 Rand, but then the supplier charges you
10% of 500.
what you mean 5% of 500?
Yeah. Yeah.
5% handling fee.
Mhm.
So which is that. So how would I treat this? Let's say we're using the perpetual system. I'll still, when I bought the inventory, I recorded 500 Rand in my books, right? And then you will credit obviously your bank with 500 Rand. Now you're returning it. I will credit the 500 Rand to show that I no longer have that cost, and I will debit 500 Rand if they want to refund me in cash. This 25 Rand, I'll treat it as an expense because it's not really related to the purchase of inventory. So it is an expense, it's an additional cost that I incurred, which is not related to my inventory. So I'll debit 25 Rand because it's an expense for me. And then if now they just withheld it from, so you did not pay cash, they just took it, they just deducted it from the amount that you're supposed to get.
Supposed to get back, yes.
I think, so here we created the inventory and you debit the 500 Rand. Ichuches, would you help me here?
Yeah. So I think maybe it's always best to separate the amounts. So to say of the inventory, assuming let's say it's pens and you can count the pens, how much were returned, then you do the full cost for the inventory, and then if there's an additional charge, i.e., I think for the module we only do carriage, but in reality there might be other costs, then you also show the return of those costs.
Okay, I think this one is right. So
Yeah.
this one is right. You'll do it like this. When you bought it, you debited inventory 500 Rand and then you credit bank 500 Rand. Now you returned it. You credit inventory, you debit bank 500 Rand, and they charge you. You recognize the expense, you
It's
credit
an
bank.
expense.
At the end of the day, your bank, the money you receive, it's still 500 less 25 Rand. It's just
Yeah.
that it's shown in different transactions.
Yes.
100%. Thanks.
Next.
Lesedi.
Thank you. Before I ask my question, I just want to make a comment. And really, this comment, I think, goes out to all my fellow learners. And I've been saying this on the comments. If you haven't done the study units, you will find everything confusing. And it's very distracting to type in the meeting chat how lost you are or what you don't understand everything. So I would really encourage, I'm new to accounting myself, like most of you. I come from BSc Informatics. I've never done accounting in my life. But if I invest time on the study units before the class, it becomes a little bit easier. I can see exactly where I'm getting lost or where I need clarification on. But constantly sending messages about how you are lost, everything is fast, that just simply means you didn't prepare beforehand. So can I just ask that we stop doing that? If you really are lost and you've done the module, talk to the e-tutor. They will help you. And my question is really just a little bit of a confusion. It's probably something easy, but because I'm new to accounting, I just need maybe a little bit of understanding. So it was mentioned that inventory is disclosed in the statement of financial position as an asset. That makes sense to me.
Mhm.
But then in the statement of profit and loss is cost of sales.
Mhm.
So I thought cost of sales is only calculated once this sale is done. But I just need what happens to the inventory that is still left, that we still have maybe in the warehouses or wherever?
Yeah.
How do we don't report that, right? On the profit and loss and other comprehensive statement.
No,
I'm not
we
sure
don't.
if what I'm saying makes sense.
No, we don't. So let's show how I'm going to explain this. Let me
I
delete
can
this.
I can explain, Pamela. I think
Okay.
he's already halfway there.
Yeah.
So I think your point is quite right. So the question is, what you have still in the warehouse, that is what you show in the statement of financial position. And then what you have sold already in the year, i.e., it's gone, you don't have it anymore, then that will be in your statement of profit and loss, i.e., how did your business do in the year? So I think that's the main distinguishing factor between the
Yeah.
two. So what you still have, it's in your warehouse, you own it, it's an asset. That's in your financial position.
Okay. And then
Yeah.
what is sold, it's in the profit and loss statement. That's
Yes,
why it's
that-
recorded as cost of sales.
yes, exactly.
Okay.
Yeah.
Yep.
And thank you for your earlier point. I think, yeah, you've echoed what we have been trying to say. I think you have to invest time into the course and you will then get the results.
Yeah. Thank you, guys.
Thank you. We can move to Sonipile. Okay, Sonipile is still muted. Ulu, you can come in. Okay, Tulu is still. Bridget, you can come in.
Can we maybe make this the last one because we might just run out of time for the question. Maybe some questions can come after the exercise.
Okay, we're taking Bridget and Tutus and then we're done. That's it.
All right.
How do I unmute? Can you hear me?
Mm-hmm.
Oh, hi, good day. I wanted to ask, I saw somewhere while you're still teaching, you said that like the purchases account on the periodic system is an expense. So I wanted an explanation on that. Like, how is it an expense when we purchase that inventory, we're expecting to receive future potential economic benefits. So why is it an expense instead of an asset, like inventory on the perpetual system?
Okay, let me go back to the slide. Referring to this. Hello?
This one, yes, it says debit purchases expense.
So remember, in the periodic system, you don't keep continuous track of the inventories that you purchase. So you can't adjust the inventory account. You only do that at the end of the period after you do the physical inventory count. So now, for now, you hold the cost price of your inventory that you have bought in the income state, in the expense account, which is the purchases account. But at the end of the period, when you do your physical inventory count and you see how much stock are you left with, then you're gonna debit the inventory account. So it's just the timing difference. The other one, you continuously keep track of it, hence it goes straight to the inventory account. The other one, it will only go to the inventory account after you do the physical inventory account to see how much stock you have in your warehouse.
In the periodic system, are we buying once off, maybe like at the beginning of the day or what?
No, it depends. You're not buying, so it depends on your business, right? So, like for example, the example that we looked at, you bought batteries. So let's say you bought 100 batteries last year, right? And last year you only sold 80 of them. So 20 is still left. So that will become your opening stock. So this year as well, you're not going to hold on to that 10. You're going to buy more because you want to sell more. So you're going to buy, let's say, 110 more. So then you add on to that 20 batteries. So you don't buy once off. You buy per what your business need.
Okay. I still won't get why it's an expense, but I understand.
It should just, maybe you can add if I didn't explain correctly to the student.
But it's more like of like a definition thing, right? Because when we purchase, as much as it goes to the purchase account, we're expecting to sell these purchases and from that get economic benefits. So I'm confused as to like why is it classified as an expense? And also when we do the purchases returns, it's like we returning an expense. I don't quite understand the definition for in the periodic system as to why is it expenses, the purchases.
I get what you're saying, so I'll try to explain again. It's just in how the differences in the two inventory systems, right? Like the perpetual inventory system, we treat it as we adjust the inventory account because we keep continuous tracking of our inventory. We know what we bought, we know what we sell. So it's appropriate for us to adjust the inventory account. Where in the periodic one, you don't keep continuous track of it. So they say every purchase that you make, you debit the purchases account, which is an expense account. Only at the end of the period, when you do your physical inventory count, right? You take what was left from last year, what did I buy, what did I sell, what is left, whatever is left at the end of the period, then you will debit your inventory account with that amount. So it's not sure if you get it. Teachers, you can just explain further
I
to the
can try.
students the differences.
I can try and add. I think you've explained it quite perfectly. But maybe to bring in some context on why this is usually the case. So usually with the perpetual system, it's sort of on average bigger companies with systems like your Pick and Pay, where when something is sold, there's a system in the back, IT system that records everything. Whereas with your periodic, it's usually more of your smaller businesses, individuals running their own things. So from a point of ease, perpetual, it's easy to record everything on time because it's a live system. But with periodic, which is why again you do it later, because it's usually a smaller business. The accounting system is a person. So for ease, they just say we bought this as an expense, but only at the end, then you do your calculations to say I actually still have X amount of inventory. It wasn't an expense. Then you record it as an asset. But I understand what
It's
you're
just
saying.
the timing
Yeah.
difference. The other one you do it every day whenever you make a sale or you buy. The other one at the end when you do your physical inventory count.
Oh, I understand. Thank you.
Yeah, it is. I agree. It is a bit unorthodox, but it's just, yeah.
I think we're taking the last question.
Because I just opened for you, you can go through.
Good evening.
Mhm.
So we are kind of having a debate here by the comments. I was telling the others that the cost price is always 100%. So I just wanted you to please correct me, maybe if I'm wrong, because some says it could be different. Maybe it could be 75, but then I said it's always 100. So does it change, or is it always 100% with the cost price?
So when you use, it depends what, so are you referring to the markup?
Yes, to the markup.
So if the markup is on cost price, then it's always 100%. It's expressed as 100%. So then if it's on selling price, then I said your sales is expressed as 100% because you're trying to work out your cost price.
Oh, okay.
I think it's just that the differences between which one are you using.
Oh, yes. Thank you.
Okay, I think that was the last question. I'll
Yes, it
stop
was. I think the
presenting.
others, yes. The others can note their questions and then ask at the end. Thank you.
Yeah, I'll stop presenting.
Okay. Everyone can see my screen, right?
Yes, we can.
Okay. All right. So students, this example is basically going to take us through how to record transactions on the perpetual inventory system, the periodic inventory system. The question reads as follows. Record each of the transactions listed below under the appropriate column heading in a business that uses perpetual periodic. You see here we've got number, we've got subsidiary, journal, account in the ledger to be debited or credited, assets, increase, decrease, and then this is accounting equation, assets equaling equity plus liabilities. And then when you record your transactions, you're going to decide, are we increasing an asset? Are we decreasing an asset? Are we increasing a liability? Are we decreasing equity, increasing equity? And are we decreasing liability or are we increasing liability? Okay.
Officer, sorry to interject. They asking that we increase the font, the screen. Zoom in.
Zoom in to the screen like that. Okay. So basically we must answer this question using this template here. Ignore that. That's important because later you won't ignore that, but for now, ignore that. So we've heard that the periodic system inventory is only recorded at the end of your period, right? As the perpetual, it's constantly being recorded, right? So that means that what we need to know our distinctions. We need to know that on the perpetual, we're going to have inventory, line item, as well as cost of sales. But on the periodic, we're not going to have inventory and cost of sales. We're going to have purchases and related accounts, and it's all going to go to the expenses. Okay. So transactions, purchased inventory on credit, 4,000 Rand. Paid carriage on purchases by EFT, 400 Rand. Transaction 3, purchased inventory and paid by EFT, 8,000 Rand. Sold half of the inventory on hand for cash, 10,000 Rand. Inventory with a cost price of 1,000 Rand was sold on credit for 2,100 Rand, right? And then inventory purchased on credit was returned to the seller, 200 Rand. Okay. So we'll keep going back and forth. So so basically this is just essentially how we're going to record the solution. Okay. I'm going to start with the periodic because I think that's the easiest of them all. And I think we can get through that one much quicker. Okay. So let's go with the first transaction. Purchased inventory on credit, 4,000 Rand. Is the poll ready, guys?
No, we don't have a poll, so they're gonna post the multiple choice here on the chat. We don't have
Okay, cool.
access. Mhm.
All right, cool. I can't see the chat, obviously, so you guys will tell me what's going on. Okay, subsidiary journal. For the first transaction, purchased inventory on credit, 4,000 Rand. What subsidiary journal are we using? Under the periodic inventory system. Are they getting it right?
Yes, they're writing purchase journal, so they're getting it
All
right.
right. Okay. So we're going to record this into the purchases. Excuse my spelling, guys. Purchases journal. Okay. Which account are we going to debit? Remembering that it's the periodic inventory system. Okay, we're going to debit the purchases account.
Purchases. Mhm.
Okay. And then remember the question is saying we bought the inventory on credit. So what account are we going to credit to show that we've purchased the inventory on credit? We're getting it right.
Payables, yeah.
Okay, we're gonna credit. What is it called? It's called trade payable control. Okay, right. All right. Now remember we said purchases are expensed. So which one of these are we going to record the purchases in? Assets, equity, liabilities. Are they getting it?
In
Or they-
answers, we have equity and assets.
Sorry?
Increase in assets, we have two answers. Increase in assets and payment liabilities and equity. So yeah.
Okay, so remember, guys, we said that this is an expense, right? So the expense is going to do what? It's going to reduce our equity, right? So therefore, the 4,000 Rand is going to reduce our equity by 4,000. All right. Then what is the trade payables? We credit trade payables. What does that do? That's going to increase our liabilities, right? All right. Are there any recurring questions regarding what I've just done?
The students are aligned. They say the same thing.
Okay. Cool. Then the second transaction, we paid carriage on purchases by EFT, right? So remember, we're still in the periodic system. So we're still recording all our inventory transactions as an expense. This time it's carriage on purchases. Sorry, it's the cash payments journal, right? Why is it the cash payments journal? Because we purchased by EFT, right? We should all know what an EFT is. Okay. And then the account that we're going to debit is carriage on purchases, right? And just like we debited, and just like with the transaction above, right? When we expense carriage on purchases, that's going to reduce our equity. So that's going to take our equity down by 400 Rand, right? Which account are we going to credit? Okay,
Bank.
we're gonna credit the bank, right? Why? Because we paid by EFT. Now, what does the bank do? The bank reduces assets. Everyone happy with that? So essentially, your equity is going down and your assets are going down by 400 Rand. Okay. Okay, and then the third transaction is purchased inventory and paid by EFT, right? 8,000 Rand. So this transaction and this transaction are essentially the same, right? With the only difference being that this transaction is on credit and this transaction is on cash, right? So it's the cash payments journal because we're paying using cash. Debit purchases, right? And credit bank, right? Purchases again. Our equity is going down this time by 8,000, right? And then our bank is also going down by 8,000. Okay, are they following? Is everyone following? Are there any questions so far?
I think maybe the one thing which was asked in the questions is just to point out the difference between the perpetual and the periodic, that in the perpetual, inventory acquired is an asset, but in the periodic, inventory purchased is put under equity. Because I think everyone is asking, why is inventory not going to
But
assets?
remember, I said we're gonna start with the periodic system,
Yes,
but we're
yes,
gonna move to the perpetual.
yes. Yeah,
So, okay.
I'm just
So,
highlighting that. So I'm saying you're right.
okay.
I'm just highlighting for the people who are asking in the questions, why are we
Okay.
not showing inventory purchases to equity? So I'm saying you are right, but I'm just highlighting for those questions because there's a couple of them.
Okay, so guys, remember we're doing the periodic system. I started with that one first because it's the most
Yeah.
straightforward one of them all, right? We're gonna spend a little bit of time on the perpetual one,
Yeah,
right?
you're happy, good.
Okay. Then transaction 4, sold half of the inventory on hand for cash. When we see cash, we know which journal is that. That's the cash receipts journal. Cash receipts because we're making a sale, so cash is coming in, right? So cash receipts journal, right? And then because we received cash, we're going to debit bank, right? And then what account do we credit, everyone? We're gonna credit sales. Everyone happy with that? And then the amount is 10,000 Rand. Then remember, sales increases your equity, right? So therefore, we're gonna put 10,000 Rand under equity. Okay. Then transaction number 5, inventory with a cost price of 1,000 was sold on credit for 2,100. Now let's remember something. Because we don't remember under the periodic system, we don't record cost of sales and we don't record inventory. So whilst this is important information, it doesn't matter for purposes of this specific transaction, right? The only thing that matters here is that it was sold on credit for 2,100. Okay. So now we need to record this sale. Okay. So therefore, the subsidiary journal is going to be the sales journal, right? And because we are selling this inventory on credit, we're going to debit trade receivables control. Okay. And then we are going to credit sales because we're making a sale. Now, your trade receivables, that is an asset. So your assets are going to increase by 2,100, right? And remember, your sales is going to increase your equity by 2,100. All right. And then onto the last transaction, inventory purchased on credit was returned to the seller and it was worth 200 Rand. So important here to understand that we purchased it on credit, right? So if we returned it and it was purchased on credit, we know that our trade payables has to be reduced, right? Okay, so the last transaction is gonna go into the purchases returns journal, right? And then because we had purchased it on credit, so therefore we are going to debit trade payables control because we owe less money now to our creditor because the item has been returned, right? And then what we credit is not purchases, but purchases returned, right? Purchases returns, right? Now, when we debit trade payable control, what are we doing? We are reducing our liability, right? So our liability is going down by 200 Rand, right? And then remember that the purchases return is no longer an expense, right? So when we recorded purchases, this was an expense. The purchases returns is a reversal of that expense, so therefore our equity is increasing by 200 Rand. Okay, let's take some questions based on what I have here on the screen.
Okay, we have a comment that says 200 is on the wrong side.
What do you mean? Why is it on the wrong side?
I'm not sure. Let's see if she has raised her hand. Maybe she'll elaborate. Maybe explain again why we did the specific transaction so that she follows.
Okay, are you talking? Okay, remember your trade. Okay, your trade. So you are returning an inventory item back to your supplier. You owed your supplier 200 Rand. You no longer owe your supplier 200 Rand, right? Your liabilities, right, are now decreasing by 200, right? That's what this is representing, right? So yes, it's a debit to trade payable control, but what I'm showing here is that your liability is going down by 200 Rand, right? And then why I'm increasing equity. Remember, when we record our purchases, right, we are reducing our equity. It's an expense. But now this expense is no longer been incurred. So we're reversing out this expense. And that's why your equity is going up by 200 Rand. Does that answer the question? Okay, can we take some questions there so that maybe I can just maybe if there's confusion I can walk people through this.
I have 11 hands up. I'll suggest maybe do the perpetual so that when we take questions, we just take them once. Is that fine? Because checking on time. I want to.
Yeah, that's true. I don't know. What do you guys suggest? Just we do perpetual.
Yeah. And then when we
Okay.
go through questions, we know it's questions and then we close it. We get
Okay,
thumbs
cool.
up as well.
Sorry.
All right. Yes.
I know they forgot to mute my mic, so I'll just jump in and ask before we move on from the periodic. And I guess that's where the confusion was on the chat, and I'm confused as well. So you're on equity and liabilities. The debits are on the left, and that's where it decreases.
No, okay. I wouldn't think of it that way. You see, do you see what the question is asking us to do, right? It's asking us to fill it in this way. So when
Yes,
we say,
correct.
yeah.
But you see, equity is on the left. Equity minus is on the left, but on your side, equity the minus is on the right. So I think that's the part that is
Oh,
confusing us. Yeah.
oh, okay.
For
Sorry,
equity
guys.
and for liabilities.
Oh, so do you want me to? I can swap them around if you want.
Please. Yeah.
Let's see if I can cut this. Sorry. I'm sure it should be fine. Is that better?
That is much better.
Okay.
Thank
All
you.
right. Sorry, guys. I think. Yeah. Okay. Let me just put it there then. Okay. Okay. I hope that is a little bit better than for everybody. Does it look more like the solution?
Getting thumbs up.
All right, cool. So then let me go to the perpetual. So I'm assuming then I'd have to do the same for the perpetual. Which is I'd have to do that. Right, so my minus. Yeah, it confuses me a little bit, this one, but anyways, I can work with it. Take that liabilities. Okay, cool. All right, cool. So, okay, first transaction. Okay, now we are on the perpetual system, guys. Okay, purchase inventory on credit 4,000 Rand, right? Now, remember, because it's perpetual, we are always valuing our inventory, right? So, sorry, the subsidiary journal is going to be exactly the same, right? So it's going to be the purchases journal. So I'm just going to link to here, right? Okay. Debit this time goes to inventory, right? And then the credit goes to, same as the other side, goes to trade payable control because we're buying on credit. Okay. And because now we are debiting inventory, our assets are going up by 4,000, right? And then we're crediting our liabilities, which means that our liabilities are also going up. So yeah, going up by 4,000 Rand. Okay. Transaction number 2, paid carriage on purchases, 400 Rand, right? Remember, we are using the perpetual system, right? But we paid by EFT, so therefore we are in the cash payments journal, right? Sorry, cash payments journal. Okay. So because we're paying via cash, we know that our credit must go to bank, right? But we're paying for carriage and purchases, which is part of the cost of acquiring your inventory. So therefore, we debit inventory, right? And then again, asset is up 400. And then this time we are crediting bank. So asset is also going down by 400 Rand. Okay. Transaction number 3, purchased inventory paid by EFT, 8,000 Rand, right? Okay, we paid by EFT, so we know that we need to be in the cash payments journal, right? Okay. We know that because we're in the cash payments journal, our credit has to go to bank, right? And our debit, well, we purchased inventory. So because we're in the periodic system, we must debit inventory. Inventory is increasing, which means my assets are up 8,000. Bank is decreasing, which means my assets are down by 8,000. Okay. Sold half the inventory on hand for cash, 10,000 Rand. Now, because we're in the periodic system, we can't just record the sale. Remember over here, we said we sold half the inventory for 10,000, but we only recorded the sale, right? We didn't record the cost of the sale. But because we're in the perpetual, we have to record the cost of the sale. So let's deal with the selling of this inventory. We sold this inventory for 10,000, right? And for cash. So because we sold for cash, we are in the cash receipts journal, right? Because in the cash receipts journal, we have to debit bank, right? And we made a sale, so we have to credit sales. We're debiting bank, so that means that our assets are up 10,000, right? Crediting sales means our equity is up 10,000, right? But now we have to calculate the inventory on hand, and it says we sold half the inventory on hand. Now we have to determine how much inventory we have on hand. Okay. So therefore, remember that we purchased inventory and credit for 4,000, right, over there. We then paid for carriage, 400, over there. We then purchased more inventory, right, for 8,000 over there. So up until this transaction, we had purchased inventory worth 12,400. 4,000 plus 400 plus 8,000, right? That's all the inventory we had purchased. How much of it did we sell? We sold half of it. So 12,400 Rand at 50% is 6,200. That's the value of inventory we've sold, right? How do we account for the sale of inventory? Well, we debit cost of sales, right? Sorry, that's in the wrong spot. We debit cost of sales, right? And guess which account we credit? We credit the inventory account, right? Because now, remember, we are in the perpetual system. So we are constantly monitoring our inventory. So here we purchased, and when we sell, we get rid of it. So we credit it, right? Cost of sales is an expense, right? So an expense is going to reduce our equity, right? By how much are we reducing our equity? We are reducing our equity by the 6,200, which is the value of the inventory, right, that we have sold. So therefore, inventory is an asset, right? Our asset is, we are getting rid of the asset. So therefore, we have to reduce assets by 6,200. Okay. Move on. Okay, 2 more transactions left, and then we're going to take questions. Okay. Number 5. Inventory with a cost price of 1,000 was sold and credit for 2,100. Remember, I said in the periodic system, we are ignoring this cost price. So if we go back here, remember here, we've only recorded the sale of 2,100 and we ignored the cost price. But because we're in the periodic system, we can't ignore the cost price anymore. So therefore, this time, because we're selling on credit, we have to be in the sales journal, right? Sales journal. And because we're selling on credit, we know that we have to debit trade payables control, right? And of course, we're selling inventory, so therefore we have to credit sales. And that is for an amount. Trade payable control is increasing by 2,100, is an asset increasing by 2,100. Sales is income, which increases your equity by the same amount, 2,100. But because we are in the periodic inventory system, we now have to account for the cost of that inventory. We know that we've sold the inventory, so therefore we must credit inventory, right? Sorry, guys. And then the contra account is going to be
Sorry, there's just a correction on the chat. It's trade receivables.
Oh, sorry, did I type? Yeah, sorry. Trade receivables, no problem. Trade receivables control, right? All right, and then the inventory. So cost of sales is an expense. Expense reduces equity by how much? By 1,000 rand, right? Because they told us that the cost of that inventory was 1,000, right? And then the inventory is decreasing by how much? By 1,000 rand as well. So therefore, we're showing that our assets are decreasing by 1,000 rand. Okay. Then last part, number 6, inventory purchased on credit was returned to the seller, right? So here we're going to be in the purchases returns journal, right? And because inventory was returned, we need to reduce our inventory. So we credit our inventory, right? But then because we had purchased it on credit, we know that we need to debit our trade payables control, right? Now debiting trade payables control, so we know that our liabilities are reducing. Liabilities are reducing by the 200 rand. Let me just try and fix this. Okay. We know that our liabilities are reducing by 200. Inventory is an asset. The asset is being credited, which means our asset is also going down by 200 rand. Okay. Questions?
Okay. We have a one
Just
errata
just
on
before
cost
the
of sales.
question on the yes, yeah, Kutu, you can go. I was gonna say the
Yeah.
same thing.
On cost of sales, equity should be on the negative side. It's just on the wrong. The 1,000 rand.
Yes, of course. Sorry, yeah, it's because I couldn't see that I was scrolling. Okay, yeah, it should be down 1,000, and then the inventory is going down, so the asset should be down 1,000. Sorry for that. Okay. Any other issues? Is anything else fine? Okay. Should we go for questions?
We haven't getting thumbs up. Let me unlock people and then they shall follow. I give them access. Then Grenwell, you can go. Casper, you can come through. You can be the first.
I also think if people have questions, since there's a lot of people, I think some can also put them in the chat. And once I see that there's quite some consistent questions coming through, I'll also just raise those. Because I don't think we'll be able to go through everyone's question, but some people might have similar questions.
Okay, I see that the first one dropped their hand, and then the My Life one is there's no name. Maybe she or he can come through. My Life. If we don't not getting a response, we can move to
Hello.
Luande. Okay, you can come in. It's fine, Mike.
Hello, how are you?
Good on you.
I'm good. I just wanted to get clarity on the periodic.
Yes.
Why is bank credited on 400 on the second transaction?
Because it says in the question that we paid the carriage on purchases by EFT. Whenever you see EFT, we must just know that that's bank, right? In other words, it means we just made a transfer on the bank account.
Oh, we
to the
paid.
supplier. Yeah.
Okay, then I have like two more questions.
Go for it.
Actually, I just like wanted clarity on the transaction, the last transaction of the periodic. clarity on like the last transaction.
I want me to explain it again. Okay.
Yeah.
So what it's saying is inventory purchased on credit. So that's the first thing you have to take into account. The inventory was purchased on credit, right?
Mm-hmm.
What that should tell you immediately is that when the inventory was purchased, the credit went to trade payables, right?
Yeah.
So you already know that. Was returned to the seller, right? So we gave it back to the seller. So in other words, we purchased this inventory on credit initially, but now we're taking it back to the seller. When we purchased it initially, right? What did we do? Because we're on periodic, when we purchased it, we said debit purchases, right?
Okay.
And then we said credit, trade, payables, control. That's what we did initially, right? For
Okay.
200. And then that's purchases, that's the expense down 200. And then your liability would have gone up by 200, right? That's what we did initially. See that?
Yeah, that's what we did.
Okay. So now they're saying to us, actually, we've now taken this inventory back, right? Which means we must reverse this transaction, right?
Mm-hmm.
So we now have to credit purchases, but we don't call it purchases, right? We take it to the purchases returns journal. It serves the exact same purpose. We could have called it purchases, but for ease of accounting, we take it to the purchases returns journal, right? So you see here we're debited, now we're reversing, we credit to that. And we had reduced our equity, right? But now we're increasing our equity, which means that these transactions cancel out, right?
Yeah.
And then same with trade payables control. Initially, we had said, okay, we're buying this on credit, we owe 200, right? Let's just freeze these panes here. We said we owe 200, but since we returned this, we don't owe this money anymore. So we must debit trade payable control, right? And then we reduce our liability by 200. So that's the logic of the last transaction.
Okay, now I get it. The last one, I would like you to repeat like number 5 on the perpetual, because I had like network problems. I didn't like get it clear.
Okay. So it's the exact same what I just explained, except instead of crediting purchases returns. So here you credit purchase returns, right? And because the initial transaction was in the income statement, now you have to reverse it in the income statement. But here, we don't record inventory in the income statement, record it on the balance sheet. So therefore, you credit inventory, but because now we're creating inventory, the asset must go down by 200.
Is it number 5, please, not number 6? Number 6, I understand it. I understood.
Oh, okay. Sorry. Okay, you wanted this one, number 5. Okay.
Yeah.
Okay. So do you understand the sales part? Because I think that one is straightforward.
The
You made a
sales part, yeah.
sale, so you debit trade receivable control, credit sales, and then your trade receivable is an asset. It increases by 2.1. Sales is an income. Equity increases by 2.1. You get that part?
Yeah,
okay.
It's clear.
But now, because we're on the perpetual, sorry, every time you sell inventory, you must account for the cost of sale. Remember here, every time we sold inventory, we didn't account for cost of sale. So here we sold, we didn't account for it. And here we also sold, we didn't account for it for cost of sales, right?
Yeah.
But in the perpetual, you have to account for cost of sales. So when you're accounting for cost of sales, what are you doing? Remember, you have sold the inventory. So the inventory is no longer in the books. So that's why you credit inventory and your asset reduces, right?
Okay.
You then take that inventory to the expense. So you put it in cost of sales, right?
Yeah.
And that reduces the equity by 1,000. such that your profit on this transaction is 1,100 rand. Okay.
Okay. No, all right. Thank you so much. I got it.
Cool.
Thank
Next
you.
question.
Luande and then Palace.
Hello.
Sure.
Okay, so I wanted to ask, okay, so when there's a sale, will there always be 4 accounts affected, just like transaction number 4 and 5? I think we had a sale in transaction number
Yes.
4, then we had a credit sale in transaction number 5.
Yeah. So if it's on the perpetual system, if it's a normal sale without any funny business, there should always be 4 accounts. You're recording 2
Okay.
transactions, but in 4 accounts. So the one transaction is the sale, the other transaction is the cost of the sale, right? But obviously it's in
Yes,
these
sir.
4 different accounts.
Okay. If you don't mind, can you please explain transaction number 1 again on the periodic system?
The periodic, this one here.
Yes, sir.
Okay. So what is it saying? It's saying you have purchased inventory on credit, right? 4,000 rand. When you see on credit, right, that should immediately tell you either it's trade payables control or trade receivable control. But because we made a purchase, we're buying something, so we know that this is going to be in trade payables control because we're going to owe the creditor money, right? And then you can see that we've
Yes, sir.
purchased inventory for 4,000 rand, right? But because of the inventory method that we are using, we are not going to debit inventory, right? Remember, the inventory is only debited at the end, right? But up until the end of the period, for every purchase of inventory, right, or any addition to the cost of inventory is going to start in the income statement. Okay. And it's going to go into purchases or carriage on purchases. So therefore, we are purchasing on credit. So we credit our trade payables control, which increases our liability. You see that? But because we're using a periodic system, our debit is not going to inventory, it's
Yes,
going
sir.
to purchases. And we said that purchases is an expense. It's going on the income state. It's an expense. So therefore, it's going to reduce my equity.
Okay. All right, I think I get it now.
Cool.
All right, thank you very much.
All right. Next question.
Palesa and then T Maziva. Then if they're not opening up, we'll go to Norisha. Okay, they're also not opening their mics. We'll go to Andrew. Andrew is not opening his
Sorry.
mic.
Could you please repeat? I think it's number 4 on the perpetual. I'm just interested in seeing how you determined the cost of sales. Yeah. The
Okay.
rest is fine. Yeah.
So they're saying here, sold half of the inventory on hand. On hand when? At the point at which we make this sale, right? Whatever was on hand, we sold half of it, right? Now, how do we determine what is on hand? Well, we have to look at the transactions that have come before, right? We purchased inventory for 4,000, right? So which means up to this point, we have 4,000 in inventory on hand. We paid carriage on the purchases. Remember, this is cost. This is part of the cost of acquiring your inventory, right? So it gets capitalized to inventory 400. So up to this point, we have inventory of 4,400. We then purchased more inventory and we paid 8,000 rand. So 4,400 plus 8,000 is 12,400, which is what we have here. 4,000 plus 400 plus 8,000 is 12,400. So we know at this point we're sitting with inventory of 12,400. And then it tells us we sold half of this inventory.
Crystal
So
clear.
Sorry?
Crystal clear.
Cool.
Yeah,
So that's
it's
how we
half.
get that's
Sure.
how we get that.
Thanks.
Cool.
Okay, we can have Michelle. And then, okay, Michelle drop there. Do we still have money? We can, okay, I don't know the order anymore. We can have Robert and then Palis and then Little and all. Then the ones I missed, they can just come in.
Hello, ma'am. How are you?
Okay, you can come in, it's fine.
Hello, do you hear me?
Yes, we
Yes,
can.
yes, can hear you.
Yes, for today, I think I did understand. My question is on the past assessment. I just want to ask on past assessment, on other modules, when we attempt an assessment, we get a review where we can see where we can see our questions and our responses. So on this module, we didn't get a review where we can see where we get from. So what I did to me, I attempted my first attempt, and then I got a certain percentage. So, but it was not 100%. Then I go back to my study unit, and I did revision. So that I get back to second attempt, and I get the same percentage again. That was not 100%. So now I didn't know where exactly I go wrong. So is there any way where I can get a revision so that I be able to get focused on where exactly I go wrong on this assessment?
Can I-
Because I was revising and I know where I was. So I didn't know where exactly I go wrong. So is there a
So-
chance we can get clarity on the past assessment?
Okay, before we answer your question, I think can we please students try to stick to this? We can answer your question, but please can we stick to this question, because I think we just want
Yeah.
to, we don't want to ask other questions now, but we can just answer this one question. Please go
But,
for it, guys, if you have an answer.
But
Hi.
just to quickly
Sorry.
on that one, there's a class on the 2nd of April. So I think the class on the 2nd of April will be specifically on the assessment one. So I think all of those types of questions will be specifically handled there. So I think, yeah, so I think to focus on what we are looking at now or working on, I think we will focus on this question, but I think assessment one feedback and questions will be, I think, probably handled in that class.
Okay, thank you very much.
All right, guys, can we just try and ask questions related to this specific example today? And then the rest of them, please, you can ask your lecturers, you can ask the e-tutors in the various e-tutor sites and the social media. But for today, let's just stick to this so that we can get the most out of this exercise. Okay, any more questions relating to the exercise?
Hello, can you hear me?
Yes, I can.
My question is about the carriage transaction. What I want to know is that in the event of the periodic inventory system, if carriage was to be replaced with something like import duties, would import duties also be a separate account, like a specific account? I don't know if I'm making. So instead of carriage, it's import duties.
Import duties. I suppose if they, yeah, please go for it. Go for it.
Can take that one. So in general, the theory says any cost that you have incurred in the process of acquiring an asset, i.e. your inventory, would be a cost that's added. So to answer this question specifically, yes, but I think for this module, it looks like most of the times to not overly complicate, I think they'll use transport or carriage. But if import duties were included, yes. At times it's also like other things. I can't think of them specifically, but again, if there's any cost that you have to incur to get your goods delivered, all of those costs would be added to your inventory.
Okay, thank you.
Thank you. Next question.
Narisha, you have your mic open. Okay, Narisha is not speaking. Michelle?
Oh, I just wanted to ask regarding the inventory account. So I just wanted to ask, so when it's the periodic one, it's an expense, and then if it's perpetual, then it's an asset. Is it like that?
That's exactly
'Cause
what it is. Yeah.
oh, okay, thank you.
Okay, and then I think we have Leslie Noel and then Wiseman.
Good day, sir.
So,
How are you, sir?
good on yourself.
I'm good. Sir, for the matter of determining the selling price and the cost price, are we always gonna be given the way these transactions are given, or are there gonna be sometimes where we're given the percentage?
I don't not sure. At some stage you're gonna have to calculate it. I don't think they'll make it this straightforward, hey?
Yeah.
Because this is very straightforward. You're gonna have to do a little bit of maths. But this is more to introduce you to the principles, but I can't see it being this straightforward. I think you're gonna have to determine the selling price. Sorry, the cost price. Maybe the selling price as well. Because they might tell you inventory with a cost price of 1,000 was sold for a markup of 70% or whatever. So yeah, so it's very likely. Remember the slides we did at the beginning? You're gonna have to go through those. I doubt they're gonna make it this straightforward.
Yeah,
Oh,
and I think that's why I think in general for accounting and I think most modules, you have to also spend time just practicing other different examples. And I think as you
Yes.
practice more, then you will encounter different ways that questions can get asked. But yeah, I don't think it will also be as simple as Dolisa said.
okay, I understand, sir. So it's not only determine the cost price and the selling price, you can also determine the markup percentage using the entries that we are given, right?
Depends on whatever they give you in the question and what they want. But usually you're gonna have to determine either the selling price or you're gonna have to determine the cost price. So if they give you the selling price, they say you sold for 10,000, then they'll give you enough information to determine the cost price, but they won't tell you we sold 5,000 rands worth of inventory. They will make it such that they will probably say we sold inventory for 10,000 at a markup of 30%, and then you can then assume that there's a cost associated with it, and then you have to calculate, and then you debit cost of sales, credit inventory.
Okay, thank you, sir.
You could probably also assume that most of your questions for inventory are probably going to be around periodic. Not that they won't ask perpetual, but it is very straightforward. Maybe you might have to calculate, maybe they might ask you to calculate the cost of sales at the end or something, because that's the only thing that's really challenging. But otherwise, the perpetual system is where you have to do most of your thinking,
Oh, okay,
especially
sir.
around cost of sales.
Okay, sir. So now, so if you have two transactions that consist of cost of sales and sales, and then you calculate the markup percentage using both of them, that means something is wrong.
I don't understand the question, sorry.
Oh, you have two transactions, and then you determine the cost of sales and the sales. You use those two transactions. For the first one, you calculate the markup percentage, the profit markup percentage, and then the second one, you calculate the profit markup percentage. If you don't get the same percentage, does that mean it's wrong?
Well, I think I get your question. Depends on what the items being sold are. Presumably the same item would be sold at the same markup, but I guess it could depend if a business has more than one item.
Inventory.
Yeah, because if it's the same type of inventory and the same type of sales, probably your markup percentage
be
will
the
be
same.
I can't imagine why a business would sell the same item at 30% and at 20%. I don't know why that would happen. But if it's different items, then yes, maybe it can have a different markup percentage.
Okay, thank you, sir.
Okay.
Thank you. Leonard will be our last hand, ne? Then we're gonna go to, because he's number 10 now. We're going to go to Wise Man and then Sipati and then Benny.
Okay. Good evening. My first question is just simple. How many types of journals should we focus on? Are we focusing on these that you highlighted here on the, in your presentation? That's my first question. Because there's purchase journal, sales, cash receipt journal, cash payment journal, purchase return journal, and sales return journal. Should we focus on those 6?
So I would say, I mean, yeah, look, I think in general, as Zolisa was saying, you just need to do as many questions as you can so that you start picking up how to record transactions. The thing is, I mean, there's only a limited number of transactions that can arise, right?
Yeah.
So you either, I mean, you're buying inventory and you're selling it. The issue.
Thank you, 2 hours.
Sorry, can you mute the mic there? Whoever's talking. So what I'm saying is that you just need to do as many cover as many questions as you can. That's the only way you start getting familiar, you know, because I think it's dangerous to say do only this and only this. You just try to do 100 questions, and redo them until you get 100%.
Okay.
So that you embed the concept.
I see.
That's all I can say. And go through your notes, because the theory will also to help solidify the concept.
I see. Okay. And then my next question also, I think the answer would be similar between the periodic and perpetual, systems. Would you recommend that you also pay equal attention to both so that you can grasp, the overall knowledge?
Yeah, it's a difficult question to say. If I was a lecturer, I'd test mostly the perpetual, because that's the one where you have to think more.
Okay.
Because I think the periodic one, again, as I'm saying, it's fairly straightforward. You purchase inventory and you record your expense, and then it's either on credit or for cash. And I think that once you know your perpetual, I think the periodic is very straightforward. But I don't want to speak for the lecturers because I don't know what they're going to test. But I mean, I think you will find that if you do a few of the periodic, You'll find that it's very straightforward. Except obviously you just maybe have to determine cost of sales at the end. But I think most of the work must surely come from the perpetual system. I don't know
Yeah.
if I'm right,
Just,
teachers.
and just to add, I think also the questions will not only just be journals. So I think for this class, we focused on journals, but there's also the financial position. There's also the cost of sales. So I think because the amount of things that can be asked is quite wide, they can choose either. I think for journals, I think most likely periodic, but again, depends on what the lecturers are trying to pull out in terms from the students. But there's so much more of other content which wasn't covered here, which can be asked, so it can go either way.
Okay, excellent. So it's better to go through your study unit, from page 1 to the end where there are calculations, just to get used to it.
Yeah.
Okay, thank
Yeah,
you very much.
if I can
Sorry.
add, you see, in this question, the question that we just did, we said ignore VAT. So in other questions, there might be VAT in it. So
Yeah.
this one was just more basic. So that's why they say just go do more questions.
Excellent. Okay, thank you very much. I'm covered.
And that's a general comment, guys, for everyone. Your key for passing accounting is questions. And it's doing the questions. It's not reading the questions and reading the solution. It's doing the questions until you get it right. Because that's how you solidify the concepts, right? If you're running out of time, I'd rather do questions than do theory. When it comes to accounting, you get so much more value out of questions. Next question.
Okay, we have Constance and then Penny.
Good morning, lecturers. I just want to find out with regards to the paid carriage on purchases by EFT, because on the slide we shared that we assumed that the EFT is cash, whereas I'm thinking, what if could this EFT just be a method of payment, but not rather saying, why do we have to assume that it was because it was EFT, then we record it as cash. It was
Well,
paid by cash
not
instead
assuming.
of.
I mean, and when you do an EFT, you do it off your bank account, so it's not an assumption. It is cash.
EFT can also be credit. It can also be done from a credit.
No,
Or
no,
is
no,
it?
no, no.
It's a credit card. A credit card
Yes.
is also bank.
Yes.
So
Because
trade
it's cash in
payables.
your credit card.
Yes. So trade payables is when you owe the store or you owe the person you're buying from. If you owe a bank, that's the seller doesn't care.
Or the source, or here we're
Yes.
concentrating at the source, not on the method of payment, as I had.
Yes.
Maybe it's where I'm confused.
Yeah. So you as the customer took credit to make the payment, but the business received cash.
Oh yes, okay.
Yeah.
Yeah,
Yeah,
okay.
so
Okay,
when you
my
say
second.
when it says you, oh sorry, go for it. Yes.
No, go for it. It's fine. It's a
I'm saying
different.
when it says you purchased on credit, it just means that you purchased and you didn't pay for it immediately. That's basically all it is.
Okay, it's understandable. Okay, I just wanted to ask, because some of our assessment also or exams, they are procured. So are we allowed to use our cell phone for calculations, or should we use Excel? We stick on what is on Excel for calculations. Are we use external materials for calculations?
I don't know the answer to that. Other e-tutors, can you help me with that?
No, maybe one of the lecturers can answer that question for us.
Yeah,
Let me
but
come in. Like you said, most of the questions will be answered on the second in that class that is coming. But however, I think the student is just asking how to calculate if the question requires a calculation. If you can do the calculation by the calculator, you can use the calculator. You don't necessarily need to use an Excel spreadsheet. I'm not sure if I answered the question.
Okay.
I think
No,
I
I
think
just
they were also asking if they can use their phone.
For the phone, yes. If the phone has a calculator, yes, they can use.
Okay.
okay, so you cannot be penalized for that. Oh,
Remember, it's just to calculate the figure that you are going to put in the
yes.
answer sheet. So whatever method you are using to calculate, up to you.
Okay. Thank you.
Yeah. All right.
Thanks.
Okay. Constance, just to add on, remember to show your calculations on the document as well when you're calculating them. That will assist as well to get marks. And then we'll go to Benny and then Chokwe.
Yeah, good evening.
Evening.
So I'm a bit lost, or I'm not sure. Maybe I'm the one who did the wrong thing on my side, because on the first transaction on the perpetual inventory system, the transaction, it says we purchased inventory on credit. Then on
Yes.
your on your slide you did record inventory at 4,000, then trade payables 4,000. But you did record, I'm not sure, maybe I didn't see properly, record the 4,000 on the asset side. Are we not recording on the liabilities?
The liability is increasing by 4,000.
Okay, so I think I didn't see properly. I saw as if
Okay.
it was on the asset side with 4,000.
Okay, yeah. So the inventory, the asset was 4,000, but then also the payable was 4,000.
No, okay, no, I'm sorted. That was the question. I didn't see properly. Thank you so much.
Oh.
Chokwe?
No.
You can ask your question.
No, it's just okay.
Okay, Eva. Eva is not coming up as well. Then we can have Nindi Nima. That one. Sorry if I mispronounce your name. You are next.
That's fine. Good evening.
Evening.
My question is regarding the perpetual accounting. I think that's what it's called. Sorry.
Yes.
So I am looking at the 400 where you paid for on purchase on carriage, right?
Correct.
And then where it now said sold half of the inventory on hand for cash. Is that 400 not part of the 6,200 that is being minused?
It absolutely is. So
Is that
remember
not
we said
double the you're
yes.
doing duplicating the transaction?
I don't understand. Remember we said we purchased 4,000 worth of inventory, right?
Yes.
Then we had to pay presumably 400 to get the inventory in, right?
Yes.
And then we purchased more inventory for 8,000. So therefore, our total cost of acquiring the inventory is 12,400, right?
Okay.
And then half of the value of the 12,400 is the 6,200. I'm not sure if I'm answering your question correctly.
Okay, so the 400 doesn't just apply to that 4,000 that was purchased.
It could apply. I'm assuming it. I'm assuming it
Okay.
is, but it's just part of the cost of purchase.
Okay, so it's not stated that it applies only to that 4,000. It's just in general.
It's
Yeah.
I think, yeah, I think based on how the question is worded, it sounds like the 400 relates to the 4,000.
Okay.
Yeah, I hear what you're saying. You're saying, because as an example, if you just randomly paid for 400, that would
Yeah.
be an expense. But I think for this question, it sounds like the 400, because again, it's relating to the inventory, which relates to the 4,000 of inventory.
Mm.
Yeah.
But now my question is, because now we're looking at half of the total cost, we've already minus that 400 as this on the second, right? Let's assume it's the second. We've minus that 400. Isn't now a percentage of that 400 again being minused when we do the sold half of the inventory on hand for cash?
So remember, this is part of the cost of the inventory. Just like the 4,000 is a cost of inventory and the 8,000 is a cost of inventory, right?
Yeah.
So the value of your inventory, right? So if whatever you purchased, the value of it includes the 400. The 400 is part of the cost of that inventory
Okay. So
that you're going to use to calculate your profit when you make a sale.
okay, could I please see how it was handled in the periodic?
Okay, so we said paid for it in cash, so cash payments journal. So we credited our bank, reduced our assets,
Yeah.
right? But remember, we don't record to inventory because it's a periodic inventory method. So
Yeah.
therefore, we take it to the expense, just like we took purchases to the expense. We take this to the expense, and it reduces our equity at
Okay.
400.
Thank you.
Okay.
Thank you. And then we're on our last question. Kanya, you can come in.
Can you hear me?
Yes.
Yes. I just wanted to ask, I think it's also maybe a question on what another student asked. For example, let's take, for example, that transaction number 3 where it says we purchased inventory and paid by EFT. Now, my question comes when it specifically says that you paid it by EFT, meaning that you paid via the bank that I get. But when the transaction says that at that date of transaction, the bank balance was unfavorable. And we know that if it's unfavorable, it's over an overdraft. So technically, meaning you are owing the bank. So would that account, if they give you that further information, would the other account be then a payable in that you are owing the bank, even though you paid by EFT, but your bank balance was unfavorable?
No.
I don't know.
The fact that you are paying by EFT, look, if you have an overdraft, you can still pay for stuff, right? And all that EFT is saying is that you took money out of your account and you paid it to the supplier. Whether your account is an overdraft or you've got a favorable balance is irrelevant, right? All you are doing is if you have an overdraft and you pay by EFT, you are just increasing your overdraft. Basically, is what you're doing.
Oh, okay. So it doesn't.
So you're paying your supplier by cash, but then simultaneously, obviously now, whatever you owe your bank, you're gonna owe your bank more if you're in overdraft. Whereas if you
Yes.
weren't in overdraft, you would just reduce the cash balance that you had.
Oh, okay. Got it.
Yeah. Yeah. And just to add to that,
So can I just maybe cement this? So technically, you still increasing or decreasing your bank, but the overdraft is a transaction on its own. It's a payable on its own, whether you owe the bank or not. It's a separate transaction. It's not like involved in the transactions of you purchasing inventory.
No,
yes,
it's
I-
not. Oh,
Oh,
sorry,
cool.
go for it, Zolisa.
yeah, I was gonna add to that to say that's a separate transaction. So
Oh,
that's
okay.
now between you and your
The bank.
Yes, which is again a separate transaction. But for the purchase of the inventory, it means you received inventory and cash went out. So the person you're buying from, they received cash. On the back end, there's a separate second transaction where you now owe your bank more. And again, further along the course or in accounting too, then you even calculate interest on that amount you owe, but that has nothing to do with the interest, with the acquisition of the inventory. It's like part two. It's like going to borrow from a friend and saying, please borrow me 2,000, I need to buy inventory. That's a separate transaction where you borrow money, but then when you buy the inventory, that's a standalone transaction.
Got you. Thank you very much.
Thank you. And then the student number is the last person. Then we should be done. Still not coming through. I think we are done with questions. Thank you.
Okay, guys, thank you very much. I do appreciate all your questions. And just remember, guys, the only thing to do is to practice. There's no other way. There's nothing else you can do to pass this module apart from doing as many questions as you can and doing them properly and marking your attempt properly. And then eventually it just becomes easier and easier. From me, thank you.
Thank you.
Thank you. Bye.
Bye.
Thank you. Bye.
Bye.
Everyone.